In the late 1960s, a new trend began to emerge in the U.S. market: REITs, real estate investment trusts. For most investors, it looked like a clear opportunity. Real estate prices were rising, capital was flowing in, and most importantly, everyone believed the trend would continue. The crowd saw opportunity. Soros saw a cycle. He didn't just look at what was happening. He tried to understand what would happen next if market beliefs kept drifting further from reality. In his view, things tend to follow a familiar pattern. Early stage, rising prices attract attention. Second stage, capital flows in, pushing prices up faster. Third stage, expectations detach from reality, forming a bubble. Final stage, sentiment reverses and the market collapses. Most investors only see the first two stages. Soros saw the ending, so he didn't pick one side. He chose both. At first, Soros aggressively bought REITs as the uptrend became clear. He didn't fight the market, he moved with it. But when he began to see signs of a bubble, prices rising faster than underlying value, capital flows becoming irrational, he did something very few were willing to do. He reversed. Soros started shorting the very assets he had previously been buying. This wasn't just a financial decision. It was a psychological one. Because to do that, he had to accept, but wrong in the long term. The crowd can be right in the short term, but wrong in the long term. The results were clear. He made about $1 million during the market's rise, and even more when it collapsed. Within a few years, his fund was nearly doubling annually, reaching around $50 million by 1973. A similar example appeared decades later during the 2008 U.S. housing crisis. Most of the market believed home prices couldn't fall. A small group of investors, like Michael Burry, saw the opposite and bet on the collapse. Soros had done something very similar, nearly 40 years earlier. The difference wasn't that he predicted the market perfectly. It was that he understood how markets behave when people become overly confident. More importantly, he didn't just observe the cycle, he acted before it was complete. If you judge by the number of trades, George Soros wouldn't look like a busy investor. He's not someone constantly entering positions or reacting to every small market move. Most of the time, he waits. But when he acts, he moves in size. His style can be summed up in one simple principle. You don't need to be right often. You just need to be right at the moments that matter. While many traders aim for steady gains from frequent smaller trades, Soros focuses on dislocations, moments when the market drifts furthest from reality. And when he sees that, he doesn't bet small, he bets big. In many cases, he's willing to commit a large portion, sometimes nearly all of his portfolio, to a single idea. That's why people don't just see him as an investor, but as someone willing to go all in when the odds are in his favor. There's a well-known story in finance where Soros once told a colleague, "If you have a really good idea, go big." This goes directly against traditional risk management, where diversification is used to minimize mistakes. But Soros sees it differently. He believes, risk isn't about betting big. Risk is not understanding what you're doing. That doesn't mean he's always right. In fact, Soros has openly admitted that he's wrong quite often. The difference is, when he's wrong, he cuts losses quickly. When he's right, he lets profits run and maximizes them. One interesting detail, Soros once said he could feel when he was wrong, sometimes even physically, like a backache. And when that happens, he doesn't argue with the market, he gets out. This approach makes his style feel less like traditional investing and more like warfare. Few trades, but every decision carries real weight. It's not blind risk-taking. It's a combination of conviction, discipline, and the ability to admit when you're wrong. And it's exactly this style that led to the kind of decisive, high-impact moves that built George Soros's reputation in the financial world. As the 1970s began, the financial world was no longer the same. The Bretton Woods system collapsed, and the US dollar was no longer tied to gold. Markets became more volatile than ever. For many investors, this was a period of instability. For Soros, It was an opportunity. While most investors continued to look at markets in isolation, stocks, bonds, commodities, Soros saw a much bigger picture. He realized global finance is an interconnected system. Movements in one place can ripple across the world. Together with Jim Rogers, his key partner at the time, Soros began implementing a different kind of strategy: global investing. They didn't limit themselves to the US. They searched for opportunities across the world. One early example was their investment in bank stocks. Soros and Rogers recognized that the interest rate environment was creating favorable conditions for the sector. The result, around 50% returns in less than a year. But they didn't stop there. Soros began turning his attention to international markets, especially Japan, which was experiencing rapid post-war economic growth. In a bold move, he allocated about 1/3 of the fund into Japanese markets. The result? That investment doubled within a year. Beyond Japan, he also invested in markets like France and the Netherlands, places that many American investors at the time largely ignored. In the first 10 years, the results were extraordinary. The fund grew by around 3,000%. By 1980, it had reached approximately $381 million. Soros named it the Quantum Fund, inspired by quantum physics, where outcomes are driven by probability and uncertainty. The name wasn't random. It reflected how he saw the world, not as a stable system, but as something constantly in flux. What set Soros apart during this period? It wasn't just the returns. It was how he changed the game. While most investors were still operating within familiar boundaries, Soros stepped into a global arena, and that shift put him years ahead of the rest of the market. After a decade of exceptional growth, George Soros entered the 1980s with strong confidence. The Quantum Fund had grown to hundreds of millions of dollars, and his name was becoming well known in financial circles. But this was also the moment he faced a test every investor eventually encounters: mistakes. Based on his analysis, Soros believed the US economy was heading toward a recession. One key signal he focused on was an inverted yield curve, often seen as a warning sign of an upcoming economic downturn. From a logical standpoint, he wasn't wrong. He made a large, macro-level bet. Long-term bonds, expecting interest rates to fall during a recession. Short stocks and short-term bonds, expecting markets to decline. This was classic Soros when he had conviction. He went in big. But reality didn't unfold the way he expected. Instead of weakening, the economy continued to grow in the short term. The stock market kept rising, and his positions started moving against him. The key issue was, he was right in logic, but wrong in timing. And in financial markets, timing can matter more than being right. The result? Soros lost around $80 million. The fund dropped about 22%. Roughly 50% of investors withdrew their capital. It was the first major shock of his career. A man who had been consistently winning was now being beaten by the market. The pressure wasn't just financial, it was psychological. When investors pull out, it's not just a loss of capital, it's a loss of trust. Faced with this situation, Soros made a surprising decision. He stepped away, at least for a while. But the real significance wasn't the failure, it was the lesson. The market can stay irrational longer than you can stay solvent. This idea would later become a guiding principle for many investors. He mistaked in 1980 didn't destroy Soros. It reshaped him. And from that point on, he understood something much more deeply. Being right isn't enough. You have to be right at the right time.